This past week, the markets have just been in complete turmoil after the Fed came out saying that they have raised interest rates 75 basis points. You can see the markets did not take it so well. And now that we're actually getting a lot of red guys and further deepening this bear market, I figured that there might be a pretty good decent chance that there are good buys out there. So I actually want to start this mini series looking at each individual sector and picking out 3 companies that I have yet to analyze on the channel and go through them really quickly to see if whether or not with the current fall they are a pretty good buy. And of course, we're going to start off with this video in the technology sector. So I want to actually try to find companies here, 3 companies that are a pretty good buy that I have yet to cover or haven't covered a lot on the channel before. So we're going to pretty much avoid the mega caps and any other ones that I have analyzed rather recently, and we're going to see if maybe with the current fall it is a good buy. So with that said, let's get started with this video. And the first company that we're going to take a look at, guys, is actually Texas Instrument. Realize I have never done this company before, and I figured that it might be a pretty good buy today. And a little bit of news on this company: they recently just raised the dividend by 8% to $1.24 and also authorized a $15 billion share buyback, which is fairly good. Looking at the current dividend yield, guys, you can see they pay out 3.08%, $1.24 per share, with an annual payout of $4.96, 16 consecutive years of dividend growth with a double-digit CAGR of 18.13%. Now, while this dividend raise is actually fairly decent, guys, as you can see, the payout ratios in regards to the cash flows are a little bit high. However, their fundamentals actually aren't that bad. You can see increasing net income by 111%. Free cash flow is increasing at 35%, though rather stagnant, but an increase nonetheless. Fairly good increasing revenue of 22.61%. Increasing assets minus liabilities with an average assets minus liabilities of around $10.8 billion. Cash flow minus liabilities, however, is going deeper and deeper into the red, with an average of negative $3.5 billion. A very good share buyback, and as you guys just saw, they are planning on buying $15 billion of share back. So that's actually fairly good. On the 5-year, they have bought back around 7%, and from the previous to the current year, around 1%. And they currently have $3.8 billion in cash and equivalents with an average of around $3 billion. Coming over here to the assumptions, guys, with a current share price of $161.29, you can clearly see that we are pretty much a buy at the median assumption of a revenue growth of 10% and a projected share buyback of 6%, and of course a required rate of return of 10%. Even with the highest margin of safety, we are still below it at around $162.25. So if you believe my median assumption to my highest assumption, this is looking like a pretty good buy. And also, even though their payout ratio in regards to their cash flow is fairly high at 70 and 80%, they still pay out a fairly good dividend, guys. You can see annual of around $176.06 for $5,725 invested in this company today, which again, it is a fairly good buy in accordance to my assumptions. All in all, that is essentially Texas Instrument. And now let's take a look at the second company, Applied Materials. Guys, this company is actually on the 52-week low. As you can see here, $82.67 to $167.06. On the 1 year, they are down 40.27%, and the year to date, they're down 47.3%. Current share price of $84.29. So this actually might serve as a pretty good buy right now. Looking at the dividend yield, guys, they currently do 1.23%, which ends up being 26 cents per share for an annual payout of 1.04. A 5-year CAGR of, look at this, 20.11% with 4 consecutive years of dividend payments. Looking into the calculator, guys, we got a PE of 11.28%, and the payout ratios in regards to the cash flows are actually fairly low as well, meaning that they actually might be able to sustain that 20% CAGR. And looking at their fundamentals, they aren't too shabby either. The net income, it is actually increasing by 67%, the free cash flow increasing by 39%, revenue increasing by almost 57%, assets minus liabilities, currently they're at $12 billion. As you can see, from 4 years ago, they have been consistently increasing. Average assets minus the average liabilities is around almost $10 billion. Cash flow minus liabilities, however, is actually on the decline pretty consistently year over year, with an average cash flow minus liabilities of almost -$8 billion. A very good buyback on their shares, you can see very consistently within the past 5 years of 18.84% from the previous to the current year of 3.55%, which is actually a really good amount, and the cash equivalents of almost $3 billion with an average of $4 billion. And now making some assumptions of low, medium, high revenue growth of 13, 15, and 17%, and predicted share buyback of 8, 9, and 10%, we can see that, well, we are in a pretty good buying range, guys, from the median assumption for both adjusting for debt and not adjusting for debt, and even up to the first 5% of margin of safety. And for the highest assumption, we are essentially in a buy zone from the 10% margin of safety all the way up to a target share price not adjusting for debt. So as it currently stands, based off of my assumption, this is looking like a very good buy. And now looking at the dividends, obviously $1.04 per year isn't a lot. However, it is telling me that it's a good buy, and they have a massive CAGR of 20%. Doing this buy, guys, at the current share price, putting in $5,725, this would net you an annual dividends of $70.64. All in all, Applied Materials might actually be a fairly decent buy now that it has fallen a significant amount from a high of almost $170. And lastly, guys, we got the company Accenture. This company is actually in the 52-week low. So you can see right here, $256 at the lowest, and the highest was $417. Current share price after market, guys, is actually $261. So we are essentially at the 52-week low end. So you can see on the year to date, it is down 24.2, and the year to date, we are down 36.16. This company does pay out a dividend of 1.72%, which ends up being $1.12 for an annual payout of $4.48, 5-year CAGR of 9.9 with only 2 consecutive years of dividend growth. Now, this is a little bit concerning. However, if we take a look at the dividend history, we can see that they actually went from paying semi-annually to now quarterly. So it's not necessarily that they cut the dividend, it's just that they changed the frequency of dividend payouts. Coming now into the calculator, looking at ACN, we got the PE of 24.28, a little bit high. However, they do have a lot of good stuff going for them, including, guys, this payout ratio in regards to the free cash flow of 32 to almost 40%, which tells me that annual dividends per share of $4.48 is actually sustainable. Looking now at these fundamentals, you guys can see it is amazing. Very consistent increasing net income, 69% with the past 5 years. Free cash flow also consistently increasing, 63%, increasing revenue as well, 50.26%. Assets minus liabilities also increasing, with an average assets minus liabilities is around $18 billion. The cash flow minus liabilities, however, could be a little bit better. It is consistently decreasing, with an average cash flow minus an average liabilities of almost $12 billion. A very good share buyback, guys, consistently decreasing at 1.1% within the past 5 years, and from the previous to the current year, it is also a decrease of around 0.02%, and with an average cash and equivalents today of almost $7.9 billion with an average of $7.3 billion. And looking now at some valuations, we can see that with a revenue growth of 7, 10, and 13%, and a predicted share buyback of 0.5 and 1%, that the target share prices are actually fairly low, not adjusting for debt. Adjusting for debt, though, they actually go significantly higher to $355 to $435 at my highest assumption. And as you can see, it is looking like an all-out buy with a current share price of, we just saw, of around $259 to around $261 after market. With these margins of safeties, it is telling me that it is an all-out buy across the board. And with this annual dividends per share of $4.48, putting in $5,725, this would net you an annual dividends, guys, of $98.66. Fairly low. However, guys, based off of the target share prices adjusting for debt, it is looking like a very decent buy. All in all, when it comes to Accenture, this company has amazing fundamentals, and I think it is worth around the $300 mark, meaning that the current share price of $260 or so, it is fairly good. And that pretty much does it for the 3 companies that I found to be a fairly decent value today that aren't mega caps and that I haven't done in the channel before. come back guys for the next video of this mini series where we're going to analyze the communications sector where, well, we have a lot of red here guys, and this should be fairly interesting. So that pretty much does it for this video guys. Like to feel, like, comment, subscribe. Remember, this was not financial advice. It never is. Every investment is the present value of all future cash flow. This is why I have all of these calculators available for everybody to have. Once again, like to feel, like, comment, subscribe. Really does help her with the algorithm on YouTube. You guys can follow me on my new tech sites. Link in the description below. So with that said, peace out, and I will see you all in the next video.